If you don't have enough humility in life, it probably means you do not have kids and you do not invest in the stock market. When we had our first kid, when we had Bowen, Burge and I were so proud of what good sleep trainers we were, and Bo was such a good sleeper, and he was sleeping through the night. Probably, I think 3 months in, he was sleeping through the night. I mean, fully through the night, like 8 hours, 9 hours or something. And so Burge and I were so proud that we were these amazing, sleep training parents, and what amazing parents we were. And then Everly came along, completely different person. We did all the same, exactly the same sleep training, read the same books again. And though she did start sleeping through the night at the exact same time Bowen did at 3 months old, she's a bit of a night owl. And where Bo, when he was young, would easily go to sleep at 6:30. Even today, being 8.5 years old, he goes to sleep easily at 7:30. Ever at 5 years old, even at 9, she still wants to hang out and stay up. So, humility comes with having kids and investing in the stock market. Even when you have a strategy that works and you know it's working, there's still going to be points where you have a lot of humility. And investors are going to need a lot of humility over the next couple years because we are in what I call a contraction cycle, which I could also call a uncertainty cycle. And there is something very, very interesting going on right now. But even more important than it being interesting is extremely important. And you've often heard me say that important trumps interesting. I know the newsletter, the Pick of the Week, Pick of the Month newsletter industry sells interesting up the wazoo. But it's actually what's important that is most important for your money. So with that, I want to talk about a handful of very scary charts. Hey everybody, this is RC Peck, and this is my weekend podcast. It is episode 339. It's July 9th. So good to have you here. And there is a lot of stuff going on. Now, what's going on today, though specifically has never happened before, but we've been in this part. The financial markets, the financial world, the planet has been in this situation 2 times before. This is the 3rd time we've been in what I call a contraction cycle. And when the markets are in a contraction cycle, they have a lot of uncertainty. And when I saw this picture kind of gave me that feeling of uncertainty, like you wouldn't believe. So what I want to do is I want to show you what I think are probably 5 of the scariest charts out there. And they're really important charts, whether you live in Australia, New Zealand, Hong Kong, Singapore, China, Malaysia, Thailand, US, Canada, the UK, Europe, Russia. These are very important charts, and some of them are very scary. So the first one I want to look at is the largest bank in the world based on assets. And the largest bank in the world based on assets is HSBC, a Hong Kong Shanghai Bank Company or Bank Corporation. But that's HSBC. It's the largest bank in the UK. It's the 6th. Sorry, guys, I'm not being clear. It is the largest bank in the UK. It is the 6th largest bank in the world. The first 4 largest banks are Chinese. I think the 5th is American, and then you got a Japanese and a Chinese one, maybe squeezed in there. But this is the largest bank in the UK and the 6th largest in the world, and this is HSBC. Now, the red line here is the low of 2009 during the global financial crisis. And so here we are, HSBC is down to about $30, which it was up to about 50. It almost hit about 50, not quite, but it's down about 40% from its high in 2013 and never got above its high back in 2007. And so HSBC is really struggling. The Brexit is in here a little bit, but as you can tell, other major things were going on for the UK banking sector before the Brexit came along. And believe it or not, this is going to be one of the better looking price charts you see. So this is the largest bank in the UK and the 6th largest in the world. The second one I want to show you is the largest bank in France, BNP, and it's the 8th largest bank on the planet. Now this looks a little bit worse. This is actually down 50% since its high in 2014 and never was able to break above its 2007 high. So you've got the largest bank in France and the 8th largest in the world that's down almost 50%. And that is not a good sign for France. The third price chart I want to show you, which is probably the scariest of all the 6 charts I'm showing you, is the largest bank in Germany. Germany is the largest economy in Europe. Europe is the largest economy on the planet. The Earth is the 3rd planet from the sun. But Deutsche Bank is the 10th largest bank on the planet. And I got to tell you, I'm looking at this. Here's its low back in 2009, 2008, 2009 when the world was ending. And it is way below that number. It's at $13. I got to tell you guys, this looks like it's going to zero. And this is uncertainty if you've ever seen uncertainty. This is the largest bank in Germany. Not the largest in the world. It's the 10th largest in the world. And things are definitely going wrong at Deutsche Bank. Very scary. This is one of the reasons why we see yields plunging all over the world. Then we have the largest bank in Spain, Banco Santander. I've never actually said that name out loud before. It's the 20th largest bank in the world, and it is above its 2009 lows. But look at here, 2012 bottomed right here about $3.90. 2016 bottomed about $3.90, and it's at about $3.90. If it breaks below that, it's going down to this number down here, which is probably about $2.75. Guys, Spain is not doing well. Its largest bank is not doing well. This is a very scary chart if you want things, or if you believe things are getting better in Europe. So far, the charts I've shown you tell a very different story. Okay, the next bank is UniCredit. Now, UniCredit is the largest bank in Italy, okay, and it's the 26th largest bank on the planet. Now, the interesting thing about Italy is Italy has 30% non-performing loans that the banks own. 30% of the loans that the banks own are non-performing. Now, to put that into perspective, here in the U.S., in 2008 and 2009, we had 1.5% of our bank loans non-performing. That's 1.5, not even 2%. And Italy is at 30% with non-performing loans. I am surprised UniCredit doesn't look worse, but you can see it's at its 2012 lows, which are at about $2. So this is not looking good. Actually, it's not $2, guys. I misspoke there. It's at about $7, maybe a little bit below $7, but this is telling us Italy is in real trouble. Germany is in real trouble. France probably is in real trouble too. UK. All of these banks were in trouble before the Brexit. They were happening. The pain was happening way before the vote a little over 2 weeks ago. And then I have a bank for you in Switzerland. UBS is the largest bank in Switzerland, and it's the 27th largest bank on the planet based on assets under management, or assets. And if you look at this, it's actually doing the best too. It hit a high just recently here. These dates down here are off, and I don't know. The price is correct, but I don't know why these dates are off. It's actually managing itself the best out of all of the banks. So, we kind of think of Switzerland as a place to manage their money well. What's crazy about Switzerland is all the debt from 30-day, 90-day, 1 year, 2 year, 5 year, 10 year, 20 year, 30 year, 40 year, it's all yielding negative interest rates right now. This is amazing. If you take all these banks kind of globally and you say, what is the European banking system looking like? This is my 7th price chart too, and I just want to show this to you. If you look at this right here, this is the European banking sector right here. It's hard to tell, but where it ended today is just $1 above its 2012 and 2011 lows. So does Europe's banking sector bottom, or does it break through? And this is all the banks. This is not just the largest. But if we look at all the largest, those 6 charts from those 6 countries are very scary looking. I mean, it actually makes the U.S. look like we're doing, things the right way. And relatively speaking, we are doing things the right way in comparison to what Europe is doing. But look, Europe is in the driver's seat right now, and it is really defining what's going on in the world markets. And that's very important to know, because what goes on over there will affect us over here in the US and the rest of the world. Doesn't necessarily mean negatively affect us, but it absolutely will affect us. So what is the takeaway? So the first takeaway is right now, guys, it's all about European banking right now. And I showed you what I think are 6 of the scariest charts right now in the world. Because, guys, if that's what the best and the biggest banks look like in those 6 countries, Europe's in trouble. They can print more money. They can drop their yields even more negative. But until those banks get righted, this has not been cleaned up. And our banks in the US aren't necessarily clean either, but man, the worst looking banks in the world right now are Europe. So what is the takeaway? What's to do? So first of all, the focus on the world right now is Euro's banking system right now. That's number one. Okay, but what's the takeaway? Volatility is absolutely going to increase. The amount that yields have fallen over the last 2 weeks has been very remarkable. We've seen things that this planet has never seen before. At the same time, we see volatility increasing with precious metals. Now, in this case, volatility is to the upside. People never really notice volatility when it's to the upside. They only complain about it when it's to the downside. But I've said this for years that when we are in this contraction cycle, it is an uncertainty cycle, and volatility will increase during the entire cycle, and we are not out of the cycle yet. The second thing I want to point out is the stock market. The U.S. stock market broke to new lifetime highs on Friday, yesterday, if you take into account reinvesting dividends. So the S&P 500 closed at a high that it's never closed at before in an absolute way. If you reinvest your dividends back into the S&P, it closed at a lifetime high yesterday on Friday. We could very well see the market break to the upside in the United States. It's been in a sideways channel for 2 years, a 15% sideways channel. But here's the thing. Whether it breaks up and goes up another 20, 30, 40%, 10%, I don't know. I'm not one to predict what it's going to go up. There will still be the comeuppance. There's still going to be a point where there is a big clean out. Now, the reason I have no more runway down is because when the markets finally cleanse themselves and discover the true price, right today, the S&P 500 has an as-reported P ratio of 24.6. That is high. That is expensive. But dividend yields are super low, so that can probably support a higher as-reported PE ratio right now. But the markets have not cleansed themselves. So even if we do break to the upside, we will see some sort of clean out in the next couple years. Yes, I guess you could say it's a bit of a prediction. I feel it's more of a forecast, which means it's based on probability. And I base this on things have not been cleaned up around the world. The amount of debt that has been built and created since the 2008-2009 global financial crisis is immense. The amount of money printing that has happened is immense. And nothing has really been cleaned up yet. And it will get cleaned up because that's what the market eventually does, is clean things up. No more runway. When the market corrects next time, whether it's 30, 40, or 50%, people in their 60s and their 70s, they're not going to have any more revenue generating runway left in front of them. When the market fell 50% when they were 50 years old back in 2000 to 2002, they still had 10 or 15 years of earnings in front of them. And those were probably their best earning years. But now those same people are 65, 66, maybe they're 70. They don't have the same runway of earning income. And you could take any age, someone who was 35 who is now 51, they don't have the same runway in front of them. And unfortunately, because they don't have that runway to earn that money for the next 15 years, that's going to greatly impact them. And that's why it's so important to focus on the probability of whether the market's going to go up or down and not whether you are diversified. Which comes to my third point. Did your strategy work the last time the stock market fell 50%? Like it did in 2008 and 2009. It actually fell 58%. Or the dot-com crash when it fell 49%. Or in 2011 when we had the debt ceiling issue between the Democrats and the Republicans, when the market only, quote unquote, only fell 19%, but over 6 weeks. Did your strategy work last time? If the answer is no, I just hold on, I'm in for the long haul, that is a broken strategy. It absolutely has to be fixed. Because look, at the end of the day, what you buy is a strategy and not a ticker symbol. You don't buy a stock. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey everybody, probably one of the best things you could ever do for your health if you aren't sure about how your health is doing, or you've gone through some pretty scary parts with your health, is to get a second opinion. Most people I meet got badly hurt in the 2000 dot-com crash and the global financial crisis crash of 2008, 2009, and they don't know what to do. It's so simple what to do. Get a second opinion. Have a second set of eyes. Look at them. Not a big box advisor, a boutique advisor, or some sort of conventional advisor, but someone who built strategies based on probability to know to get out in that 08, 09, and the 2000 to 2002. It's a simple step, and I don't know what you're going to like about it best. Either being able to identify that biggest gap you have right now and filling it, or how straightforward that solution is going to be. But whatever it is, you're going to know. And the next step is super simple. Just go ahead and call Patty, or you can email Patty at Fearless Wealth and say, hey, I want to get a second opinion with RC. Or you could say, hey, you know what I really want? I want RC to implement the strategies that he keeps talking about. I want him to implement them in my accounts for me. Please have him do that. Hey guys, thanks so much for being here. We've got a monthly strategy gathering coming up next week. A lot of great data to talk about, crazy things that are happening right now in precious metals and interest rates. And we are on the right side of both of those and have been. So it's going to be really exciting to talk about this next week. Bring your questions. I look forward to speaking with you then. All right, guys, I'll talk to you then.